Hello and welcome to the show. I'm Puneet Wadhwa and we have with us S Naren, Executive Director and CIO at ICICI Pru AMC. Hello Naren and welcome to the show.
Welcome to all the viewers of Business Standard.
Naren, 2022, it seems will have nothing for the investors to write home about amid multiple headwinds. Do you think that 2023 will be worse off than 2022 as the world battles recession instead of rate hikes and inflation?
I think 2022 was a year which showed the resilience of India. If you look at the markets, India has been one of the least volatile markets and one of the best performing markets in the world. This is because of the wonderful macro handling in 2020 by India, where we used the current account surplus to buy dollars and actually handle the entire macroeconomic situation very well. Having said that, at this point of time, India is one of the costliest markets in the world in equity, and that makes it a very different backdrop for the next 1 year. We think this results in a situation where debt is an attractive asset class, asset allocation is the way to go, and equities will remain volatile due to the risk of global recession and global growth slowdown at least. India will not have a recession, but India can have also a growth slowdown. And therefore, we are believers in both asset allocation and debt at this point of time and systematic investing in equity. But we are not fearing anything very big negative. I think the risks of a big negative are slowly going down.
For the Indian equity markets, do you think that high valuations is the single biggest risk as of now? One, and two, is that a big deterrent for domestic and foreign flows into equity markets in 2023?
Yeah, having been in the markets long, somehow high valuations actually get people invested. And we have seen that even last year when so many stocks with no earnings got traction in both US and in other places in the world. So while high valuations are supposed to be a deterrent, there are so many countries in the world today where valuations are very low, but investors are not willing to invest in. So it's very interesting, which we have seen across that, when valuations drop very low, people actually run away from those markets. And that's the reason valuations are low. And that's why I believe that we have always believed in ICICI of a counter-cyclical approach because valuations don't seem to deter people at the top and do not bring people at the bottom. And that's why valuations are low in certain markets.
So when you say that the valuations are low in certain markets geographically, does it make sense for the Indian investor to look at those markets instead of investing back here in India?
Clearly, yes. I think it makes sense to invest geographically in all the markets which have done extremely badly. And it does make sense for investors to consider those markets for investing because those markets have all done so badly in the last 1 year that it makes sense to consider some amount of investing globally at this stage, considering that each global market has underperformed India by more than 20% in the last 1 year.
The pace of demat accounts that were added in October 2022 was a little lower as compared to the previous few months. Do you think that the retail investors are now getting nervous as regards the road ahead for the market?
I don't think so. Somewhere, if you look at it, they have bought much more aggressively in April, May, June, and that was a period where the markets actually were lower than where they are now. And therefore, I would say that they have been very, very sensible that at the bottom they bought more. And now when the markets are at a high, they're selling. So somehow, maybe the mutual fund industry is also something deserves the credit that they have been very disciplined in the way that they've been investing, that SIP flows at this point of time is at record high, even though the absolute flows in equity are not at record high. So I think somewhere the mutual fund industry has worked very hard in getting investors to be sensible in investing in an aggressive asset class like equities.
So what are the top concerns of investors and companies that you talk to? Is India prepared to battle the double whammy of higher rates and recession?
I believe that, the challenges all come out of higher interest rates in the world. I think in the period from 2008 to 2021, the Fed and the European Central Bank kept printing money and thereby lubricated all the markets in the world. I don't think neither the investors nor the corporates fully understand that after 13 years of printing money, we no longer have the printing press or working by the global central banks. And I don't think the investors and the corporates are so worried as much as I am worried about the fact that we are at ICICI Prudential worried about the fact that the printing press of the global central banks are missing. And barring the Bank of Japan, there are no global central banks which are now printing money. And that worries us a lot at ICICI Prudential.
So how are you tackling that worry? How are you overcoming these fears?
See, this worry is very essentially tackled by the fact that we always recommend systematic investing, we recommend asset allocation, and we are recommending debt mutual funds for investing.
Do you think that the pace of foreign flows into Indian equities will pick up over time, or will the strain on macros and corporate earnings growth and valuations will be a deterrent?
Almost every foreign investor we meet says that India is the best structural story. And that means that over time, there is a good scope for foreign money to come into India. The challenges for a foreign investor is that Indian valuations are high, although I mentioned that actually most investors don't look at valuations. The challenge is certainly that Indian valuations are out of the roof. And over the last 10 years, India has been the best performing emerging market in the entire emerging market space. So that is a challenge I would say that we have to face, that India is today overvalued relative to the emerging market space. But I would say that when foreign investors think of the next 1 decade or the next decades, they can't come up with a single better secular growth story than India. So they would have to look at India. Whatever they do, they'll have to look at India. And that is how they are looking at it. But the current environment of very high interest rates, domestic markets which have become very cheap, are all constraining their capabilities to invest outside their home markets in a big way.
So what are the investment-worthy sectors and you find at the current levels?
Given that, we are a believer in moderate returns at this point of time, we believe that sectors like pharmaceuticals, sectors like banks, telecom, these are the kind of sectors where we are auto. These are all the sectors we like at this point of time, given that some of these have underperformed over either the short run or the medium run. And the outlook for these sectors look good over the long run. And these are some of the sectors we like at this point of time. As such, we are believers in large cap at this point of time over the mid cap and the small cap, primarily because large cap has seen sustained FII selling in the last 1 year. And therefore, we found that large caps have much more comfortable valuation compared to mid cap and small cap. And therefore, we are believers in large cap investing as a space over mid cap and small cap investing. And that is where we are at this point.
So one last question, Naren. We spoke about debt. So is it a good time for somebody to actually get into debt, given where the interest rates are headed and the outlook for the markets? Second is, should that allocation for debt come at the cost of investing in equities, or should that debt pool be completely different?
I think the equity pool should be systematic investing base. Given that valuations are not cheap, the debt pool should be separate, and it can be lump sum oriented and can be large at this point of time. Given the fact that interest rates have gone up across the world and in India, the debt pool has to be separate and large at this point of time.
Thank you, Naren, so much for joining us. We hope to see you soon.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.